Are you getting run over when you sell covered calls? What if I gave you an index that made you a better seller of covered calls so you could make more money? First, remember to click the thumbs up and subscribe. And if you click the bell, you'll get notified when we release future videos. One of the very first option trades that many investors make is to sell a covered call. It's a great structure that takes advantage of the fact that over time, options cost more than they're ultimately worth. It begins by owning the shares of a stock or ETF. Let's say you own 100 shares. You can then sell one call option against those shares. Remember that each option corresponds to 100 shares of the underlying stock or ETF. For selling that call option, you receive payment called the option premium. That premium is yours to keep no matter what. What's the risk? Well, assuming that you want to retain ownership of those shares, there's no additional risk to the downside. You'd continue to own the shares anyway. But there is risk to the upside, and that risk is the possibility that the stock or ETF will rally strongly and be above the strike price of the call you sold when that call option expires. But that risk is covered by ownership of the shares, hence the name covered call. How can you use Nations CallDex to improve the profitability of your covered call trades? Since it's an objective measure of the normalized price of the call option you might want to sell, you'll know if that call option is historically expensive, meaning it's a great candidate for a covered call, or if it's historically cheap, meaning you're probably better off looking at some alternative. Specifically, CallDex measures the normalized price of the 30-day call option that is one standard deviation out of the money. Importantly, that out-of-the-money threshold is calculated using up to the second option prices, so it's always relevant. And in delta terms, that threshold corresponds to a delta of 16. Let's take a look at CallDex on SPY, the S&P 500 ETF through time. You can see that CallDex itself bounces around as demand and supply for these call options ebbs. Going back to 2005, when we launched CallDex on SPY, the average closing value is 19.76. The median closing value is 17.19. The 25th percentile close is 13.41. And the 75th percentile, meaning that only 25% of all closing values are above this level, is 22.62. Now we have objective data to know if these call options are historically cheap or expensive. We're no longer relying on a guess or a hunch. So how can we use this data? If market conditions lead you to believe that SPY, in this example, isn't going to rally sharply over the next 30 days and that selling a covered call could be profitable if sold at an attractive price, then turn to CallDex to determine objectively if the current price is indeed attractive. If CallDex is above that average closing value, well, selling this covered call now makes sense from an historical viewpoint. And if it's above the 75th percentile, that 22.62 level, now we're using objective data to become a better trader. CallDex should not be the only metric you use. In fact, your analysis of market conditions should be your starting point. But if that analysis suggests selling a covered call, now you know what analysis you should perform next. Selling a covered call when CallDex is historically high doesn't mean the stock won't rally strongly, leaving us regretting selling the covered call, but that's generally the way to approach it. We want to buy what's cheap and sell what's expensive. And now for your covered calls, you have access to that information. Learn more about our full complement of option indexes at nationsindexes.com.